exchange. Now at the desk to help us work out where value can be found in commodity markets is Ebrahim Patel. Morning to you, Ebrahim.
Morning.
Let's start with gold. It had been on a pretty steady slide, was my impression, in the last couple of weeks, and then it was up a little bit on Monday, Tuesday. Quarterly, it's down, though, for the last quarter.
The prospects for gold currently are not looking very bullish. You've got two twin factors that you've got to consider. One is there's a stronger dollar. The dollar's up about 5.6% this quarter against a basket of 10 currencies, and that diminishes gold's attractiveness as an alternate asset. And then you've got interest rate expectations from the Fed. So we've seen U.S. new home sales hit a 6-year high for August, and you've seen the Fed on the 22nd of September saying they may accelerate interest rate increases. So on the one hand, you've got inflation, which doesn't look to be going anywhere, and you've got higher interest rates, you've got better economic data, resulting in a stronger dollar. And so gold's appeal as an alternate store of value is therefore diminished.
Ebrahim, how important is the data that we are expecting to come out later on today? I think from the US we've got durable goods, and then of course you have been talking about interest rates. Should we be watching this data that's coming out later on today with particular interest?
Correct. It's all about the economic recovery. It's about the state of the US economy, because that then feeds into the Fed's interest rates. It feeds into the strength of the dollar, and then it feeds into, as you've been saying, gold's attractiveness as an alternative to the dollar. Gold also has a safe haven status, and in a world that's quite tumultuous at the moment, you've got the US in Iraq, you've got tensions in Russia, you've got a place that's generally unsettled, that tends to help gold. But at the moment, what we're seeing is the safe haven side isn't managing to overshadow gold's role as an alternative to the dollar. And I think that's really where the story is at the moment.
Ebrahim, let's talk about oil. For a long time, it was around about 107, 108, much of the year, in fact. And then a dip below 100, and it's been around about 96, 97 for the last couple of weeks. So where's that going to go? Because it's certainly going to help us with oil imports and fuel prices, counteracting perhaps our weaker rand.
Correct. I think with oil, you're now seeing the result of increased supply, weaker demand. We've spoken about it through the months on the show, that demand isn't really going anywhere. There's a lot of excess supply, but we haven't really seen it feed through to the price. And that was probably the geopolitical tensions that kept the price perhaps a bit higher than it should have been. But you've now got the US decreasing oil imports since May. You've got German business confidence down. That puts pressure on Brent. And I think the supply situation also overshadows the military activity in Iraq and Syria currently. So definitely with oil, I think we're sort of in a bearish sideways market as it stands. But again, any uptick in geopolitical activity could well move that price upwards again.
Ebrahim, we've seen that with equities, especially with Wall Street, the S&P, the Nasdaq, the Dow Jones. Whenever we've got geopolitical tensions that are happening, we're seeing a knee-jerk reaction, and then they seem to bounce right back. Is this going to be the same situation with the commodities? Looking at oil, you did mention the US airstrikes. What type of impact is this going to have long term?
I think the thing with news is prices that are driven by news tend to be reactive. So you've got a snippet of news that comes out, the market reacts, and then if there isn't support for that trend, then you tend to see the price levels normalizing. Obviously, if you have continuous barrage of news, and if the news itself leads to fundamental changes. So if you get news out that there's a blockade on a major oil shipping route, not only is that news, there's also a fundamental effect on the logistics chain. So the reaction to that could be more sustained than, let's just say, there's some disturbances, but the channel is still open, in which case you'd see a light shift, but it would tend to normalize once there's no real impact on supply and demand.
Thanks to Ebrahim Patel, a commodity specialist at RMB.